I want to take you out to a daily chart real quick. Look at this candlestick right here on July 17th, 2024. That's the SIBI. That's what has been our objective. Likely draw us up into this in here. So if you look at the gradient levels, we have this candlestick's low. That's the high. This candlestick's high. That's the low of this SIBI. Midpoint is 20,568. Upper quadrant is 20,646 3/4. And we've seen that traded to yesterday. And when we're trading inside of areas where it may consolidate, even though you have a bullish bias, it's important you look at what overnight did. With these levels here, just note that the heavy dotted lines are respective to this individual single down close candle on the daily chart. There's going to be smaller little levels, which I'll put on the chart. Don't get them confused with the dotted lines, okay? So be mindful of that. And we're going to drop back down into a 1 minute chart. You can see the reaction off of that upper quadrant level so far. That's what this is. So we have where we are right now to this level on the upside. If everything remains bullish, this is the range that's between market price and where it would need to trade to. There is a gap. It's rather anemic, so we're not terribly excited about that so far this morning. We have some sell side down in here. Be mindful of that. A nice pool of liquidity there that may be impactful this morning's trading. We'll say that we're sticking with the bias. I stated that indices would be bullish. They're going to keep pumping them up until we get into the election. With everything being bullish and you have a consolidation range, you want to define it to time. So you have midnight and you have 5 a.m. So these are overnight hours. It's very specific times. And then what you want to do is you want to get the highest high and the lowest low between those two time reference points. Don't count the midnight candle and don't count the 5 a.m. candle. So what you'll do is the midnight candlestick and then after that, so 12:01 to 4:59. What's the highest high and the lowest low? That's the high and that's the low. Once you have that information, what you can do is you grade that price swing and you're going to be showing the quadrant levels. As you saw that I drew the fib from the highest to the lowest. This is your overnight range. So because you're in a range, you don't use this concept when the market is trending. So if it's been like just taken off from Asia and just keeps on going one direction, higher or lower, you do not use this for that. And you're part of a larger consolidation, which is what you're seeing here, all in here. We did not take out the high here and we did not take out the low here. So we're consolidating, leading up to the beginning of pre-market session for Tuesday's trading. What I've did is I've defined this overnight range and we have graded that. Now I'm going to change the levels here from a dot to a dash. Those dotted levels, that is going to be the quadrants inside that daily SIBI. Now the heavy dash line, which is defining the overnight range. When you have this information, it'll allow you to predict the general location where my PD arrays are going to form. So that way you're not surprised. They don't just jump out at you unexpectedly. The idea is I want to get an idea on how communicate to students how they can predict in the general proximity in terms of the price. Now the time aspect is always constant. You know the times. They're macros. The opening session, you have the 8:30 algo. That's when it starts spooling price, runs for liquidities. Here's the high of it, the upper quadrant, the midpoint, lower quadrant, and the low. So this is the low overnight range, high of the overnight range. For now, just understand that this is a concept that I use when the market is being held in a range. It's not being permitted to extend further overnight. It's staying in yesterday's predetermined range. So inside of the daily range of yesterday, we haven't made any new significant high or low. So because of that, I elect to use this concept. I'll look at overnight range defined by 12:01 to 4:59. What you can do with this now is think, we've been bullish. I've not been calling a crash. I've not been calling it lower. We've been focusing on primarily the higher time frame macro perspective. On the higher time frame says it's bullish because it's an election year, because it's likely to continue going higher. Where can it trade to? Well, it can trade into that larger SIBI on the daily chart. With these levels here, these dashed lines, that's on the overnight range. These smaller little dotted lines here. So here's the upper quadrant to the daily SIBI. Here's the midpoint of that. Look what happened today when we went down and made the low of the overnight range going into 4:30. It turned around in there, and look at that right there at 5:08. What's happening there time-wise? What's occurring right there at that candlestick's low? It's trading to the consequent encroachment of the daily SIBI. That's this level right here. But I'm focusing your attention right there on that midpoint. Let's go back down to the 1 minute chart. And right there on that candlestick's low, 20,567.75. It went one tick below that daily SIBI consequent encroachment. 4:50 to 5:10 a.m. That's Asia's close. We're seeing a shift from the Asian market to European London crossover into New York. So we're entering what? Pre-market session for New York session. But we still have Europe, we still have London still active. So at that moment, we can see algorithmic price delivery right to the tick, and it turns at a higher time frame level So if we're bullish on the marketplace, we're expecting price to react off of these levels and cause displacement to the upside. That means we want to see price start to run higher from it. So we see this happen here and it starts to spool higher. What is it doing? It's taking out the relative equal highs right here, which are qualified. Why? Because this high is slightly lower than that one. So what's going to be resting above that? Short-term minor buy side liquidity. So the market rallies up above that, trades into this inefficiency there, and then comes right back down into, in this price leg, it creates a fair value gap. Where is this fair value gap in proximity to this dashed line? Is it above it or is it below it? So in reference to that price and time, what time is this? 5:50 to what? 6:10 macro. Below that quadrant, when you're bullish, if a PDA forms, it is in a discount. It's also in close proximity to it, so that means we're expecting this to deliver what? A redelivery in price, which we see here. And then once more here. What time is that candlestick forming? 55 minutes after 5 a.m. Then the market does what? It delivers price higher. And what does it run for? Equilibrium of the overnight range. That's this dashed line here. Forget all of this stuff here. Forget all that for right now. It's trading into that. And then what does it do? It trades right back down into the lower quadrant once more. And does it stop there? Absolutely, it does not. Trades down into your fair value gap right there. So that makes this what? Reclaimed bullish fair value gap. And then what does the market do? Price runs from there all the way up past the minor buy side here, above this buy side, and trades right to the upper quadrant of the overnight range. Now, what do you think's above that overnight range? Look how smooth that is. Oh, I don't know, probably some buy stops. And the market runs to that level here, upper quadrant, retraces back down into what? Oh my goodness, look at this fair value gap. Here's equilibrium, okay? Just so happens there's a short-term low there. What would be there? Below that sell-side liquidity. There's your equilibrium price point of an overnight range. So what's below that in close proximity? Oh, it's just fair value gap right there when we're bullish. And is it below your equilibrium of the overnight range? Absolutely. So what is it? It's discount. So the market comes back down into a fair value gap that is in close proximity to the equilibrium price point of the overnight range. If you're bullish, the PD arrays will form at them, but below them. So we're in a discount. It has to be the time for the market to move. Otherwise, it isn't going to move. It'll stay stagnant or retrace against you. If it's being held there, that means there's manual intervention. That means they're holding it for something later in the day or the next trading day. That part, you're going to get burned by. I get burned by it. So what does it do? It drops down into some random fair value gap right here. And it's half of the move that you expect to see deliver, which is the high of the overnight range. Price rallies, draws back down into another fair value gap here. If you were looking for a long, would you be afraid to buy it in here? No. What happens when you see price on the upper half of the overnight range? You don't want to see anything come back down towards the low of the overnight range. But we have to deal with what? The opening bell. We have to anticipate some kind of volatility coming into the marketplace. But before the opening bell, what takes place at 8:30? Usually there's news. If there's any news that's on the docket for the day, it's either going to be a high impact or a medium impact news driver. But you don't need that. I'm teaching you that 8:30 is an algorithmic price delivery. The algorithm does this very thing every single day at 8:30. It will spool and it creates some kind of sentiment-driven response in traders because they want to chase it. The cheerleaders get them all riled up. It's the crowd. Well, the spectators here are the speculators. So at 8:30, there's always going to be what? There's going to be a price run. Starts just like that. And if you have a medium or high impact news driver, then it just exasperates the likelihood that the move's going to be exaggerated. And that may or may not be indicative of the underlying direction of the day, or if not very minimum, the morning session. Price comes back down. Does it go back down to the halfway point after leaving it here? No. In this area, upper quadrant, it's going to be less likely to have the same degree of precision. In the upper quadrant, there is less degree of precision because it's going to be more inclined to run and rip towards to, if it's bullish, it's going to just kind of leave that range and keep going, or at least clear the high of that range, and that high being the overnight range. The market trades back down, doesn't take out that low, doesn't trade back down to the middle of the overnight range, and consolidates roughly in here, and then reaching again still higher. We're in an upper quadrant of that daily SIBI. What's above this? We have Monday's October 14th daily high. So there's going to be buy side resting above that. If it's going to go higher, it's going to want to reach into this level. If continuing, it would likely draw that price right there is where that daily SIBI's high is. So to deliver back up to that price level would at least afford that old daily SIBI to be rebalanced. It doesn't rebalance simply because it trades there. It needs to leave the range, higher or lower. Just going back to this level here is just simply redelivery. That's not rebalanced. You can see how sloppy and disorganized it is thus far. So that's why I said we're going to be waiting until 10 o'clock and we'll see what we get there. At 6 a.m. New York local time to 9:30, this is all pre-market session. There's so much opportunity inside of that range, and you never need to trade the opening bell. You never need to trade the morning session. You never need to trade the lunch macro. You never need to trade the PM session. You never need to trade the last hour trading. If you have a job that requires you to be at work, or if you run a business, or you go to university, or if you're just simply in a different time zone and you can afford to use this area of price action, you don't need to do anything else, man. The things I'm teaching you here are very, very top tier time aspects to what the algorithm will refer to. And it's dependent on you understanding whether the market is in a protracted state. That means it's trending, it's going in one direction overnight. If it's doing that, you cannot use what I just showed you here today. So what does that mean? You're going to see this actually get used more times than when it's trending. So this is an MO in the morning where I generally will refer to what the overnight range was. I'll grade that price swing, and all I have to do is determine if I'm bullish or bearish. If I'm bullish, then I'm going to be looking for every one of these gradient levels prior to the 6 a.m. pre-market trading session. I'm going to look at those levels. This is the low, the lower quadrant, equilibrium, upper quadrant, and the high. That's easy stuff, folks. Now, what do you think would happen if we were bearish? And what we were expecting this morning, we would be looking for PD arrays to form just above these respective levels to offer us some kind of a shorting opportunity. Every macro, every 10 minutes to the top of the hour to 10 minutes after the top of the hour. How many do you have? You have 4 opportunities. Plus, you got the 8:30 algo where it comes online and starts running at 8:30. So you have 5 opportunities in pre-market. It's the equivalent of the same thing you get in the last hour of trading. You think that's coincidental? No. What makes this fair value gap good? It's below equilibrium. It's in close proximity, but it's at a discount relative to that equilibrium price point. Here is our focus for the 10 o'clock hour going into 10:30. We are looking at a abysmal opening range. We have buy side here, 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 and then we have the Monday, October 14th. We had a really very lackluster opening gap. A gap of like 45, 50 handles. I like that. That's a minimum threshold for me. But I prefer 75 handles. That's what I'm looking for. If you want to know that the morning session that I'm absolutely going in there and going right in there at the opening, as soon as the opening bell happens and we get our first print, I'm not even going to wait for the first fair value gap. That's just a model for my son, Caleb. I don't need that. I'm going to trade with 70% likelihood that it's going to go back to half the gap. If it's 75 handles or more, I'm going in there right away. That's what I'm looking for reasons to do that. But what can we do if the gap is so small, it's anemic? Just sit still. What do you wait for? You wait till 10 o'clock. You work inside that 10 o'clock to 11 o'clock silver bullet. You wait for your fair value gap to form, look for liquidity. And if it doesn't give it to you based on your bias, or if it doesn't give it to you in a clear, obvious way, then you do nothing. Why? Because you were warned ahead of time there was very little bit of excitement or displacement right at the opening bell. So that means that we can have what? A 50-50 delivery in the morning session. So what does that mean for you as a day trader, that you have a little bit more time available to you? You would simply just go, okay, I'm going to go and completely remove myself from the charts this morning, and I'll come back at 1:30. I'll watch the first 30 minutes going into 2 o'clock, and then I'll trade the PM session. Or I'm just going to let it do whatever it wants to do until 2:45, and then I'll sit down, get a view for what it's likely setting up, and then I'll trade the last hour trading. In this mentorship in 2024, I've taught you how to sit still more than any other educator out there. And it's based on sound logic, that things that repeat that tell you to sit still, it ain't worth the risk. Sit still, it ain't worth the time or the investment. The stops are going to be hit most likely. Your risk is going to be larger. The direction becomes 50-50 during a very specific session. This one, if the gap is small, sit still. Remember this sell side right here. Now, I personally would like to see the market create a close on this candlestick here, come back up, trade into this fair value gap, and then come down and take the sell side. And at 594.25 is yesterday's afternoon. At the start of the PM session, notice that 1:30, 2 o'clock. That is a very repeating level of liquidity. When you look for your session highs and lows, you want to look at between 1:30 and 2 o'clock for your PM session. And you want to do that in the previous day and the day before that. So for the last 3 days, you always want to look at the PM session highs and PM session lows. But you also want to start looking at whatever has formed at the beginning of 1:30 to 2 o'clock. That's that opening range going into the PM session. So because that time window, that 30-minute interval, is synonymous with setting up the direction, the liquidity, where the initial liquidity would be. And here you can see they created those relative equal lows, and then they rallied all the way up in the afternoon. Now we're getting ready to pierce underneath that. And it's because that liquidity is a constant. It's something that you can go back to on a time-based principle. It's a very static thing like 8:30 is, just like 9:30 to 10 o'clock is. They're very specific elements of time. So because that time aspect is finite, something that will always be a factor for the algorithm. So just know that between 1:30 and 2 o'clock, whatever has formed at that 30-minute interval, above or below it, there's going to be liquidity there. And if the market is likely to draw back into it, and you saw it again here today, see these two lows here? So upper quadrant on the daily SIBI, we're breaking down into these lows over here. And if we lose the overnight low, this level down here, then it becomes a lot more significant for the morning session. So we came down below here, and now we want to look at the overnight lows. When we're looking for morning session runs, you can use this idea, this concept, because I do it every single day, if there is not been an overnight trend. And I go in and I measure where my PD arrays should likely form around price. Then I simply submit myself to the aspect of time. I know that the macro is going to be this every 20 minutes of each hour. Whatever hour it is, 50 minutes after that hour to 10 minutes after the new hour. So it's always that 20-minute interval there. There's always some kind of price run where it's spooling for liquidity or reaching into an inefficiency. These macros are more sensitive because they're more prone to deliver price because of the increased measure of order flow that's coming in. And it's used to facilitate that, where it graduates their introduction to the marketplace, where large institutions, large firms, large insurance companies, they have big blocks of orders they have to push through the marketplace. They're not going out there and just throwing them all in one time. They're easing them in. And a dealer will facilitate that for them, who's clearing their trades for them. And they will push them through at appropriate times. Sometimes those times may be appropriate more so for the dealer, so that way they can make an in-house book. They use these macros to shove that liquidity through the marketplace. That's why they're there. The whole time, the market is being pushed through this aspect of time. And you can only get so many orders through during a small window of time. And because of that, it has to happen around a specific price level for these large entities. They just can't go in there and just buy it at the market because they feel like it's going to go higher. They have to go in measured, appropriated, staggered movements. Otherwise, they're never going to get efficient fills, because they're trying to get an average cost price that's appropriate for them. So at every 60-minute interval, there's this short little span of time. It's 20 minutes. And during that 20-minute time frame, they're shoving orders through. It's these aspects of the time element that I'm forcing you to spend more time looking at. And because we're leading up to the opening bell at 9:30, every hour that creates that macro, and during the pre-market session, that's 6 o'clock to 9:30, there is several opportunities for you to anticipate where my PD arrays are going to form. And in relationship to your bias, where it's likely to reach to, how far it's going to go. It went to the upper quadrant of that daily SIBI, sweeping the relative equal highs here, here, and here. What did they leave? Buy side. Do you, because you see this drop down in here, do you abandon the bullishness on the daily chart because you see that? So many retail traders would. It discourages them to want to be long. It discourages them to ever want to consider that maybe the higher time frame just had a little retracement today and it wants to go higher for the next 3 weeks until we get into the election. Knowing what you're looking at in terms of the delivery of market protraction, that means when the market's just running one direction, like this would be a market protraction for one-sidedness, but it's a very small one because it's only been going for about, 40 minutes or so? That's a very small market protraction. It's one-sided delivery. If the overnight is behaving that way from Asia all through London, if it's doing something like that, you do not do what I showed you this morning. But here, when it's part of a larger consolidation and there is no one-sided protraction overnight and it's part of consolidation, just simply get the high and the low and then grade it with the lower quadrant, equilibrium, and upper quadrant. Stick to the bias that's determined on the higher time frame. We have been bullish. You're going to reach for some measure of a premium array. Well, that SIBI that we looked at, that's the upper quadrant level here. And it reaches into that multiple times, offering what? It's like playing horseshoes. You ever play horseshoes in the United States? You're trying to get a ringer, it's called, where the horseshoe will go around the post. That's what you're anticipating, is you're seeing this level here, the high of the overnight range, the Monday high, and then if it was to keep going up in here, that's the high of the daily SIBI. So what you're doing is with your orders while you're long, you're tossing partials into these levels, trying to secure a ringer, trying to get a profitable exit. But if you don't know what you're doing with finding fair value gaps, this is going to help you because it's going to give you a degree of understanding, a general proximity in terms of price, where it should form, but how to qualify it. If it's below a level from the overnight range and you're bullish, that means your discount. So that means every fair value gap below these gradient levels of the overnight range, that makes it a high probability. These are the ones I'm trading on. This is the ICT fair value gap that I'm trading on. These are the ones where I go in there and I'll put 6 contracts on. It runs away from it, comes back down, touches the top of it again. I'm adding 4 more contracts there. And then it rallies up and it goes into this one here. Because it's below half of the move or equilibrium, it's still in a discount. And it's a discount relative to this level here with that fair value gap. And then I'll add more there. I'll pyramid. I taught you how to find the right fair value gaps, how to qualify and quantify them based on time, how everything comes together and it just beautifully dovetails together. And the market rallies and it reaches to clear the buy stops above here, which is the overnight range. And then it doesn't just go above here by a little bit, it goes above to touch that daily SIBI, the upper quadrant, before it completely fills it in by going all the way up to here. So there's a lot of range still there. And then that range just was increased by this dropping down, taking out overnight lows. What I'm showing you is the stuff that works. I'm telling you, when I pick the fair value gaps that I trade on, I'm using predominantly this right here, okay? There's other things that I do to further increase the likelihood of me being correct about the fair value gap. But this in itself is the easiest go-to strategy plan for you to be able to formulate an approach to saying, okay, I trust that the bias is bullish. I trust that the bias is bearish. Based on that logic, you're simply going to use this information as I showed here today. What happens when that shift in sentiment changes from you're not bullish for that morning session or that afternoon session anymore? What do you do then? Everything that you used here on the upside becomes what? Part of a market maker sell model. So everything over here that would be a bullish fair value gap would become an inversion fair value gap over here. Anything over here that would be an order block that would be bullish would be a bearish order block. It would reverse its role. This is a lower quadrant on that SIBI right here. Now, when you have a range, like overnight range, and you define it like that, other things you can do is you can do extensions off of that and get an idea how far it can go for targeting, for partials, for potential reversal patterns. And what you would do is you simply take the range. And the first one is you always want to reach for is the negative 0.5 level. And then negative 1 is 1 standard deviation. And we hit the lower quadrant on that SIBI on the daily chart. This candlestick is the SIBI I keep referring to. July 17, 2024. It's a Wednesday. That singular down close candle. That's the SIBI. Go back into a 1-minute chart. 49 is that level right there. We traded down to and below equilibrium of that daily SIBI. And what did it do there? Protraction lower, reaching down to the lower quadrant. That's the low of the daily SIBI. Here we have the session yesterday. Thursday, October 10th. 2024 daily high. So we have done what? We went above it here, came back down, went below it, once more back above it, once more below it, and then we rallied back above. And we're keeping what? Relative equal highs. We have minor buy side. And it's also what? It's an election year. It's bullish. The market's likely to continue going higher. And we've already explored the likelihood of digging back down into October 9th's daily candle. That's the high of that. So look on your daily chart, note that high. And then when you drop back down into a 1-minute chart, or in this case, it's 30 seconds. So what we're looking at is I'm not trading support and resistance, but I do use the order flow around old highs and old lows. You want to know every single daily high and low of the last 5 days and at least Friday of last week. You want to know what last week's high and low was. Those levels are going to give you what I'm going to show you right here. This is an endless supply of setups, okay? What would it feel like if you knew how to go into an endless supply of new setups that is never going to hide from you? I want you to feel happy and excited because it's absolutely an endless supply of setups. If we're bullish, by knowing the highs in the last 5 days and at least the previous week's Friday, and then knowing the previous week's high and low, you will always know where order flow is going to come in, and all you have to do is wait for the displacement. And what does that look like? Well, here we have the rally above the high on October 10th. That's this level here, okay? Putting that line on your chart, and then watching how price gyrates above it and comes back down. It doesn't stop there and go higher. Even though it's bullish, it does not stop there and go higher. It does what? It digs back down into the range. That's exactly what you want to see, because what that's doing is it's offering you the opportunity to study and measure its willingness to go deeper into that range. Does it want to do so? No. How do we know that? Because we leave that range and go back above the high of October 10th again here. And then what does it do? Do we buy it now because it does this and touches it? No. Give it an opportunity to run back down in. Does it want to take the relative equal lows here? No. It's left the bait here because you're being trained to look for relative equal lows to be traded to. But what happens if it doesn't do it? It's telling you what? It's not likely to go lower. And if it's not likely to go lower when you're already predisposed to expect higher prices, then you're in a buy program. Then expect protraction higher. You see that here. The market rallies back above October 10th. Now, are we looking for the market to come back down and touch that high like support and resistance folks would assume? No, absolutely not. What we're looking for is any inefficiency on the pass down that will act as an inversion fair value gap. That's what this is right here. Now, as it's dropping down, I'm looking at that fair value gap, knowing that if it's really good, it won't even touch it because we spent some time in here and then left it. I'm going long right in here. And then the market rallies up and it leaves these relative equal highs. And I'm noting in the video that you can watch on Twitter, I'm noting these volume imbalances. Volume imbalances are the most flexible. You're going to see price go through these types of things, okay, because it's a measurement of a willingness to see the price sustain a run higher or lower. It can be used as an entry. It can be used as a partial. It can be used as managing your stop loss. But I like looking for these little tiny pockets in price action, and it's the absence between this candlestick's body or open and this candlestick's close. There's a wick touching, but there's no bodies there. That's what I'm highlighting in that video. Same thing here, small little separation between the candlestick's bodies. There's one in here, but I'm not worried about that one because I framed one here and I framed one here, and I'm watching how price behaves. But then this fair value gap, which is what I was aiming as I entered the first time and added multiple entries on, then when it dropped down in here and it closed that initially right to that low, I fired in there again. But I had already typed out that the launch time is now. I said at 8:30, the market's going to spool higher. Go watch that recording. You'll see every annotation just as I typed it then. But I timed it and told you very specifically, the launch time is now. Why? How did I know that? How did I know that was going to happen? Because at 8:30, if I'm bullish, I want to see the price drop down to a discount array. That's this fair value gap. It could have went down and touched this inversion fair value gap, and it would have been fine. But because it didn't touch it here, and it created this fair value gap, and it already started to run up and left these relative equal highs, I know it's just coming back down in here to redeliver into here. That's why you'll see when I'm adding the executions on the chart, you'll see that that's where I fired in and added my last portion. And I already anticipated it by saying that the launch time is now. Hits it, stops the tick, and starts to rally up. And then I'm watching, do these volume imbalances support price? It trades up to it. Look at the bodies. Respecting it. Then comes back down. Look at the bodies. See that? It's respecting that inefficiency right there between these two candlestick bodies. That's exactly what I'm watching. That's algorithmic price delivery. That's the very thing that I'm looking for. And if price runs away from that, then I know that if I wanted to, I could add more when it's inside that little volume imbalance there and add more to it and then rally up. Or I could take this drop down in here and trade this inefficiency or fair value gap, and that could have been an entry. Why? Because this volume imbalance is here, and I'm trading in a fair value gap that's below that volume imbalance. That means we're in a discount during a market that's bullish after the algorithm starts firing at 8:30, and then volume imbalance right there. You can see it. They're being utilized right there. Consequent encroachment. That's the midpoint of this separation. These little pockets, these little tiny little separations in the volume of the candlestick, you cannot get this information in any other aspect of charting. I want to take a look at the executions here. As the market's trading and we're dropping down, the entries in here, look inside this fair value gap. It's in the lower half of that fair value gap. That is at the top as it's hitting it right here. In this volume imbalance, as it's trading down here, I'm trying to time it as it hits it, but it's kind of difficult when you're doing it on a 30-second chart. I'm doing it where I'm trying to enter when the market's going down. I'm never trying to go in when the market's going up. If the candlestick's painting bullishly, I don't want to be going in after the candlesticks started going higher. It opens up down here and trades higher. So it's creating a bullish candlestick. In this candlestick, I'm trying to trade as it's fluctuating around and in close proximity to that volume imbalance. That's what I'm trying to aim for. And over here, same premise. I'm trying to time it as it's entering into that volume imbalance. Here, I'm trading inside of this little separation. I'm trying to get that little return back into that candlestick as well. Here, similar. Down here, I'm trying to time it as it's trading down into this fair value gap. All of these could be further refined if I was willing to use a limit order. But I'm trying to force myself to use every aspect of proving it's not market replay. But I'm teaching you how to read 30-second chart. Why 30-second chart? Why not a 15-second chart? Because the price is a little bit cleaner, a little bit more refined. A 15-second chart's a little bit more spotty in here. Spotty means that there's a lot more volume imbalances. I like to have a chart, and this is for your notes. This is the part where you write down. I like to use a time frame that's sub 1 minute that doesn't have a plethora or a exaggerated number of volume imbalances. I want to have like a few of them. I want to be able to see them if they form, but if I'm looking at a 5-second chart, I'm going to have a whole lot more to choose from. And I don't want that. The 15-second, I didn't like it. So I focused on the 30-second. And I'm only using the 30-second chart just to kind of like drive home the emphasis that I'm a time-based price delivery trader. So because 8:30, here's the 8:30 window right there. This candlestick, when we get close to the top of the fair value gap, I'm getting in there, and then finally hammering it as it's creating that down close candle right there. I'm hitting that, and there's the entry. At the time, I'm telling you that the launch time is now. So it drops down, and then right from there, creates these little confirming that I'm on side. That's what these little candlestick bodies are telling me, folks. Okay, I'm on side, and then I'm expecting price to rip, and then you start seeing it run up. It gets this little volume imbalance tagged right there and rallies up, and then there's the objective. I told you last week that 20,538 was our objective. It didn't trade there last week, but guess what it did yesterday? It did that. So in the afternoon, what do you see here? It's a fair value gap, SIBI. Market trades up into it. I'm entering. Again, on a 30-second chart, there's my fills, and it drops down. I'm willing to see it come back up into this breaker. So that means I have to afford myself what? The likelihood of going into drawdown. But if it trades back there, I'm going to add more to it. But I need a little bit more information should it do so. What information is that? Well, it's trading up into that quadrant level. Breaks lower, creates another fair value gap, entry. I'm waiting for the market to do what? Show a willingness to take buy stops there at a quadrant. Breaks, fair value gap, entry. Same thing here. I'm looking at this wick. I'm trying to time it with this fair value gap being traded to. I want to get in there at that wick's consequent encroachment. So I'm trying to time it right there at the consequent encroachment of that wick. Right there, adding more to it. And then I shared live as it was aiming for the sell side below here, knowing that we had a abbreviated session yesterday because of the holiday. And I wanted to get out when it took that sell side there because it would most likely draw back up into the middle of the range between here and here. Worst case scenario, and best case scenario, you could come back up and try to take that high out. So I didn't want to ride any of that in. So I went short, added more there. And then the fill, as it was aiming for this low, I want to make sure I get out. So I had the limit order just above it. So there you go. That's low hanging fruit objective. That's the level I'm looking for. The sell side below that's what I want to see it trade to. But my exits are sliding on into home. I don't require that low to be taken out. Why? Because I might be wrong because it's a holiday. They may not want to come back down in there. They may want to do that at 6 o'clock's restart. This is a first presented fair value gap from last week. So I covered a lot of stuff today. I talked about how I picked the right fair value gap, what constitutes qualifying the fair value gap. I talked about the overnight range, how to use that. When is it useful? When is it not useful? If you're part of a larger consolidation, you're going to grade it. If you're doing a market protraction overnight, you're not going to do that at all, and you'll have to trade differently. And also, if you have a market protraction overnight, that usually puts you on the sidelines in the morning session. So you already had a big move overnight. So expect the New York session to be either a market reversal profile or consolidation, meaning that unless you're very versed with reversal patterns, don't trade the morning session if you have an overnight trending market, and then wait for a lunch reversal or PM session trade or trade the last hour trading. So there's a whole lot of conditions there that helps you define when you should expect something to form, when you should sit still, when should you feel comfortable sitting still, and why should you feel comfortable sitting still. Also, where the fair value gaps are best. What's the one that I have elected to trade on? And it's based on premium and discount. It's based on a previous range that the algorithm will refer back to. And what happens if you don't see these elements in price action? Then you have manual intervention. That means you should sit on your hands and don't do anything. If the PV arrays that you're highlighting are not responding and respecting price the way they should, remember, inefficiencies, fair value gaps, you don't want to see them hanging around in them. Trade into them, leave. And if you have defined your fair value gaps based on your bias, you know the general proximity of where a fair value gap or order block or breaker or stop run is going to form. All of the PD arrays are going to gravitate around these levels. Don't just think it's just fair value gap. It's not just that. It's whatever PV array that's going to be given to you at that time with price being utilized for that purpose, meaning during the macro or 8:30, because there's the only departure. There's several hours there that you can do that with. But there's one outlier. It's the 8:30. 8:30 does its own thing. That's when the algorithm comes online and it's full force, just run, because it's going to push price around for that first hour ahead of 9:30 opening. And it's also allowing a lot of orders to be pushed through when there's economic data. Remember I was telling you about earlier how the dealers, so if they're trying to unload something or acquire it, the dealer will facilitate their requirements and expectations by pushing the orders through at these very high volume times. And that's what's going on. So when you have this perfect storm of all this order flow coming in that is not causing the market to go up and down, they're utilizing that high traffic time where there's more participation. It's easy to throw those orders into the marketplace. And that's not going to cause price to go up and down. It's just going to be that much more of time and sales being booked and printed, but the price is going to go where the price is going to go. And they have no control over it. And we're looking for the maximum damage. Where can it move the most to hurt whoever's been making money?